Okay, so we have a muted start to the broader market story today, but the banks, particularly in the United States, have been surging, including names like JPMorgan after its quarterly results up more than 6%. We mentioned Citi and Wells Fargo with some, I guess, breathing a sigh of relief results, because all of these names, yes, better than expected results, but these are notable pops. Let's bring in David Nelson, Chief Strategist at Belpointe Asset Management. David, always great to see you. Am I right in that characterization? Did we feel a bit iffy about what these numbers might look like, not just because of the economy, but because of the recent banking turmoil?
I think so. I think there was a lot of trepidation coming into the quarter for a lot of names. Earnings estimates have been coming down for the market for quite some time. I think the surprise at JPMorgan, I don't think the deposit flows were a surprise, but the 21% growth in net interest income, the guidance for the year, that was probably a lot stronger than what the street was looking for. Even trading came in better than expected. And finally, they beat on expenses. You know, we talked about this on the last program, and I actually recommended this name, and I traded out of it in front of the number because I didn't think it was going to be as good as it was. So I traded too much, and I'm paying the price for it today.
It's all good. It's all good. I'm sure there's some viewers who are saying thank you for your recommendation on your last appearance. But this is an interesting point you bring up. Net interest margins. I mean, look, there are a lot of investors here who invest in Canadian bank stocks, so we always get into the nitty-gritty. But there was this belief that this period of higher interest rates would really help out the bottom line performance of the banks, because that spread on what you lend out on and what you take in looked pretty encouraging. It's just that I guess the tricky part was, well, hold on, when rates go up as quickly as they do and it starts to ripple through the broader economy, is that a good thing for the banking sector?
Whenever interest rates move dramatically in either direction, it can be pretty chaotic, because the other side of this dynamic is, you know, what does it mean for the credit profile out there, and what is it going to mean for lending? It's great if you have deposits, but if you don't have anybody to lend to, it's just an albatross on your balance sheet. You're not going to make the money. What's happened at a lot of banks, and certainly at a lot of deposit institutions and companies like Schwab and others, where they depend on making money on that spread. So many people are taking their money out of cash and putting it into T-bills. That's not money that they can make money on. So that's a challenge for a lot of banks. People are waking up to the fact that they have choices out there, and that's not that's to the detriment of the banking.
Okay, I'm going to broaden things. I know you have a couple of other ideas, which I want to get to, because, hey, you recommended JPMorgan. But before we get there, your general take on equity investing at this point. I have to say, I mean, I look at all these strategist calls, and they're all over the map. I was saying at the start of the hour, you got some people who are saying we're already in a new bull market, and then you got others out there. You know, I keep highlighting Morgan Stanley. I mean, they had the great call last year, but, you know, Mike Wilson, their strategist, keeps saying, get ready for a 20% drop in equities. That is, you know, that creates a nervous feeling for investors. Do you have a general view on where the equity market on average goes from here?
I think the markets are kind of sending a message. Look, last year, the 60-40 portfolio, that was the worst performance on record. It's never been that bad. So the snapback this year has maybe in hindsight somewhat understandable. But Mike Wilson makes some good points. The earnings estimates have been falling for months. And I think for myself, I still believe the better half of the market is going to be on the other side of July. Because at that point in time, we'll be beyond the debt ceiling confrontation that we're going to have. But portfolio and fund managers like myself, we're going to care a lot less about 2023 earnings. We're going to be looking at 2024, where the earnings backdrop is going to be a lot better. So the market performance has absolutely been heroic at this point. And frankly, if you've been leaning one way or the other, you probably missed it.
Helpful context there. I appreciate the comment about the debt ceiling, because we haven't had, it feels like, time to even talk about it, but we talked about it with political strategist Greg Valliere yesterday on our Bloomberg Markets program, and that is going to be a subject during the summer that heroic markets we'll have to navigate as well. Okay, let's just talk a little bit more about some of the other names that you're watching right now. You brought some picks to the table this morning. CME Group is one of them, and obviously exchange operators, we slice and dice them. We cover the TMX, the parent of the TSX here. But also in the travel area, Booking Holdings was on your list. Walk us through your thinking on both of those names.
All right, on CME, when the banking crisis unfolded, I try to identify names that maybe would be a net beneficiary of the action that was unfolding. So much of what happened to some of these regional banks, SVB in particular, was because they weren't hedging their interest rate risk, and they had these long-dated bonds that were just getting creamed. They're a leader in this space, and there aren't many companies I can say I've seen earnings estimates rising, but in the last 4 weeks, estimates at CME Group are up a full 8%. That's contrasted by a market where estimates are continuing to fall down. So we'll see how they report in the next couple of weeks.
Okay, and Booking?
Booking, look, I use the product. Look, it's my best consumer discretionary name. There's a reason why it's trading at near an all-time high. I think it has one of the best income statement profiles out there. Not many names out there where you get high teens growth and you're trading at only a slight premium to the market and a 5% free cash flow yield. John, the best thing I like about this company, given that it's an internet name, is that its adjusted earnings per share, what everybody looks at, and its GAAP earnings per share are pretty much the same. That tells me there's not a lot of shenanigans going on with the stock options and all kinds of nonsense that goes on the income statement. This is a top name for me.
I'm